Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 231st VideoCast podcast for the week ending March 20th, 2024. A lot of great stuff to cover. Want to start off with the family updates, and we'll get right down to it. A tremendous amount of good stuff this week. First and foremost, that's Mimi and Annabelle at swimming. Update, Mimi finaled in everything at age groups and is now the number one 11-year-old in the state in 200 backstroke and 500 freestyle. So number one 11-year-old in Connecticut. Unbelievable. I so regret missing this age group. I was in London, had an amazing trip in London, but this was a big one. But we have regionals coming up, so we'll see them there. And she also had numerous Eastern Zone Championships cuts and broke 1 minute in the 100 free. She is advancing to the Eastern Zone Championship in 2 weeks. But before that, she's off to California tomorrow to play in the Best of the Best USA Water Polo National Tournament. That's with the Olympic Development Program. I will be in Riverside, California. I fly out with her tomorrow, which is why we're doing the article and podcast a day early this week. I have one opening left on Friday afternoon for lunch. I may be able to squeeze in a breakfast opening. Any new prospective customers that are looking to come on board or existing customers that are near Riverside or obviously Orange County or LA County and can get over to Riverside and want to meet for a half hour or an hour, love to fill those two last spots and connect with you. And Annabelle, let's move over to Annabelle. She won. I don't know why they give them these professional wrestler things, but it's kind of funny. Annabelle won high point at the state championship meet for both individual and distance events. She broke 6 minutes in the 500 freestyle. By the way, she is 9 with a time of 5 minutes and 50 seconds and is now the fastest 9-year-old in the nation in the 50 freestyle, 50 backstroke, 100 freestyle, and 100 backstroke. So it was a big weekend and really proud of them. And that's her on the podium. I guess she's got to get used to that. These were the pro pictures that came back from the Princess Ball with Mimi and Annabelle. They look a lot better than my amateur pictures. That was an amazing, memorable time together. And that was in London at the Ritz. I actually stopped there on my last day. That's Harrods passing by. That's the Ritz London, which was 2 blocks away from the hotel. My amazing host, Philip and Mark, they'll remain anonymous. I think that's the way they would want it right now. Flew me over and put me up there. And this, if you go to the Ritz for lunch, I didn't even know you needed a suit. So I had this dopey jacket they gave me and like the cheapest tie you could imagine that they made me put on. I just had a nice shirt on and slacks and a nice jacket, but I didn't have a suit for lunch on a Sunday. But nonetheless, the langoustine is unbelievable. I didn't know if I should eat it or paint it. I had to ask the waitress if this stuff on top was edible. It certainly was. And then they looked at me like I had 3 heads because they had this sommelier, the wine guy came over. I don't really do wine. And I didn't want a beer because it was like midday. So I was like, yeah, could I have a Diet Coke? And they're like, yes, a Diet Coke, And so they bring over this kind of like, they pour the Diet Coke and then they bring over this breathing glass. I was literally going to start like moving it around like wine and sniffing it and saying, excellent, please serve. But anyway, something you got to do. And the sea bass is fantastic as well. So that's the Ritz. I was at the Mayfair, which was 2 blocks away, which was incredible, by the way. That's the Fabergé egg building, Big Ben, of course, Parliament, London Bridge. So I did all that stuff. It was a short trip. Winston Churchill, leadership personified. Buckingham Palace, better shot of Big Ben. And then I think that's it. So moving right along, want to thank Savyata Mishra and Bansari Kamdar for including me in their article today on the Chipotle split and Reuters. And then the coordinators for the SOAN conference Actually, Evan Sohn reached out and said that he could extend a 20% discount for any of the listeners that want to go to the Sohn conference. If you don't know what the Sohn conference is, it basically, I'll just read it here, convenes some of the best and brightest hedge fund and alternative investors in the industry to share market insights while raising funds in support of pediatric cancer and other research. So all the money goes to pediatric cancer and other research. I can't be there to attend or to speak this year. I have to be in Florida that week. But I know many of you want to attend this. David Einhorn will be a speaker this year. Scott Wapner from CNBC. Some other big names that you're probably familiar with. You can look here on the website. And many big names over the years have been speakers. Co-CIO of Bridgewater is going to be there, and more. So you can check out the website. And the website is sohnconference.org. It's April 3rd in New York. It's a full day conference. If you are general admission, it's $2,000. But if you, where's the code? You'll get $400 off. And again, all that goes to charity. Let's see if you can feel free to use this code for 20% off. Great Hill Capital will be a sponsor of that event. Despite I will be in Florida, but the code is Sohn, SOHNINVEST 20. Sohn Invest 20, all caps, all together. And you just go to this sohnconference.org/Sohn 2024 to register and save $400. But more importantly, go see a bunch of great speakers, meet some great people, and most importantly, get, well, not $2,000, but $1,600 to pediatric cancer research, which is good for everyone. So check that out. Quote of the week is: the secret to investing is to figure out the value of something and then pay a lot less. One thing I wanted to also point out for this week is I will be on terrestrial TV for the first time, the big stations, tomorrow morning, Channel 2, CBS Channel 2 in New York. You just turn on your TV. I'll be on, I believe, at 8:15, but it may be as early as 8 a.m., so put it on for the whole hour, talking about the Fed outcome today. Pretty excited to be on CBS tomorrow morning, CBS New York, Channel 2, 8 or 8:15, but tune in at 8 a.m. and check that out. Again, thank you gratefully to my wonderful hosts in London, Philip and Mark. You know who you are. By the way, they took me to the George Club, which is an amazing dining club, also in Mayfair. Highly recommend the Dover Sole. Absolutely phenomenal, and was just an all-around great time. Also got to meet one of our loyal podcast listeners, a young guy named Joe Olashugba, who has his own macro firm, and then a gentleman I met on the way home, an Indian businessman who lives in Scottsdale, sold all of his businesses, Rajiv. Welcome aboard. And also Tyler Tebbs, who I met at the Mayfair, grabbing a coffee downstairs. He does sell-side research in the UK, and as many of you know, his firm is MKP, sell-side research, and started talking to him because we're looking for more and more exposure. We had the huge hit on Rolls-Royce, which was a multi-bagger in a much shorter period of time than we anticipated, took profits on that. Now we're looking to get more UK exposure because it's undervalued in our view. And, looking at some names, we have a tiny position in ASOS, trying to get more comfort and understanding with that one. There's obviously short seller involved, but they've been wrong on a number of things that they've been short. And there's a big businessman there that had offered to take the company out at a price much higher than where we are right now. So uncertain if we're going to lean into that one or not. Looking at Endava, which we've covered on a couple, nothing material there yet. But it's nice to meet Tyler. So that was great. And then the Fed meeting today. Okay, so what happened? Let's go through some notes here. Slightly more dovish than Wall Street expected. There was a risk coming in that the Fed projections would decline from 3 cuts this year to 2 cuts on the dot plot. The Fed kept expectations at 3 cuts for the back half of the year. This was the reason for the rally following the release. The other reason was they said they were going to taper the taper imminently, which means they're going to stop draining liquidity from the market by selling bonds on the open market, and the market certainly liked that. So the thing that stood out the most was Powell signaling that the balance sheet reduction was slow. Inflation is easing. Could we still see a recession coming this year? Just the opposite. Projections for GDP went up. And so you can see here, they were expecting 1.4% GDP in December for 2024. Now they expect 2.1. They were expecting 1.8 for next year. Now they expect 2.0, and 1.9 the year after. They now expect 2.0. That's just the opposite of a recession. And unemployment projections went down. They were looking for 4.1% unemployment this year. Now they're looking for 4.0. For a recession, we would need 2 consecutive quarters of negative GDP growth like we had in 2020 and 2022. Did the latest jobs report impact the Fed's plan at all? No. However, I do think the recent inflation reports gave them pause for how quickly they want to start the 3 cuts. The sectors we're watching as in response that have been held back by higher rates will outperform in the second half. Small caps, REITs, dividend stocks in particular, international stocks benefit from a weaker dollar. And then outlook, we're constructive for the year. Short-term breather in coming weeks. We'll finish higher for the year. Average election year since 1928, 11.24. We think this time will be no different. So that's some of the key takeaways from the report. They did take core PCE inflation expectations up from 2.4 to 2.6. It's interesting that they held the 3 cuts, particularly because they're all going to have to be done basically right around election time. Historically, the Fed has stayed put around elections so as not to be viewed as political. If you know Powell and the former president's relationship, you may have reason to believe he's going to go ahead with the cuts that he intends to go ahead with. Now, I think this story is actually more important than the Fed this week as it relates to central banks, which is the Bank of Japan just handicapped a winning strategy, what to know about the yen carry trade. If you're in finance, you have to know about the carry trade. So this is a great article from Barron's that lays it out simply. What is it? It's very simple. You borrow money in a country with very low interest rates and then invest in a country where you can get considerably higher returns. Japan's central bank interest rate has been around 0 since 2016. The U.S. 10-year bond yield, by contrast, has been higher than at least 2% for most of that time. The pandemic was a lengthy exception. This is the general idea. Borrow money at 0% interest, carry it abroad to invest at 2%. The difference is your profit. It's a sure winner. Lending to governments is considered risk-free because there's virtually no chance they won't repay their debts. They can always print more money. Take your cash to other places than the U.S. and your profits could be even bigger. For example, Mexico's 10-year government bond is currently just shy of 10%. Who does it? Institutions. What could go wrong? While it seems like a sure thing and mostly has been, there are still risks. Changes in interest rates and exchange rates can either reinforce or derail the strategy. For example, the BOJ's ultra-loose policy has driven the yen to 30-year lows against the dollar, which makes the carry trade even more profitable because you're borrowing in yen at 0 rates, reinvesting in dollars, and making the spread, and then getting an appreciation in the dollar relative to the yen throughout that whole period. But if the yen starts to strengthen now, it will cut into carry trade's earnings. Rising interest rates tend to strengthen currencies by making investments in those currencies more attractive. The yen sold off on headlines that the BOJ would keep an accommodative policy for a while, but recent headlines are suggesting that further rate hikes may be forthcoming. The problem for the yen, however, is that volatility remains exceptionally low and the carry trade exceptionally popular. Is the carry trade dead? Probably not yet. Interest rates in Japan are still much lower than elsewhere. BOJ has said it will move slowly and cautiously, but the decision to raise rates does change the game, especially because the next move in interest rates in the US and Europe is expected to be down. The carry trade will almost certainly become a lot less popular. Who are the winners? This is the most important thing, and we've been hinting towards this for months, and this is key. China has the most to gain if the BOJ continues to raise interest rates, thereby strengthening the yen. China and Japan both rely heavily on exports of things like electronics and cars for economic growth, and a stronger yen compared to the yuan will make Chinese goods more attractively priced. It will also help to finally take the Chinese yuan off the mat and appreciate the yuan, which is the key that we've been looking at as it related to our exposure in China expressed in a position in Alibaba. And what we've been talking about is as the Fed eases and the dollar weakens, emerging markets will get bid and China will be a beneficiary. That is true. But what I laid out here, which is even more important, is the yuan's relationship to the US dollar. And as we can see almost perfectly, as the yuan rallied from 2000 relative to the US dollar, the yuan strengthened from 2016 to 2018. Alibaba had a parabolic move. The yuan strength is in black, the Alibaba is in red, and you can see as the yuan went up, Alibaba went parabolic, the yuan rolled over, Alibaba crashed down, and then the final rally as the yuan started to recover, you had that parabolic move into 2021 with Alibaba. Yuan rolled over, Alibaba and the rest of Chinese and K-Web stocks crashed. It's been doing this double bottom, and this could have been the sea change we have all been waiting for, ladies and gentlemen, that we get this double bottom in like we saw in 2019 and 2020 and a parabolic move up, and we get the yuan off the mat. Yuan starts to appreciate because the BOJ's new policy stance and the Fed's new policy stance, yuan being appreciative stance of tightening rates, Fed being depreciative stance of loosening rates, strengthening the yuan, which will cause the flows into China, into Chinese equities to explode yet again. No one can see that right now until it happens. And then this will be the most hated rally all the way up of all time. No one will believe it until it hits 200. Then they will hate it, and then they will join it. And that's what will happen. And today was the warning shot fired all around the world following the meeting when the Fed confirmed they were going to be dovish. And they have no choice. Bank of Japan has been the liquidity backstop for global central banks while they got inflation under control for the last 2 years. And now Japan is saying, we've got inflation coming. We want to normalize our policy. It's time for you to backstop us. We are going to normalize policy. And that is the global coordinated central bank policy that has worked so well. So now it's flip-flopping from strong dollar, weak yen, and weak foreign currencies to now weaker dollar, weaker euro, stronger yen, stronger yuan, and that will be great for Chinese equities. And I think the misnomer here for everyone chasing Japanese equities is the stronger Japanese yen, despite all the constructive developments as it relates to corporate governance and spins and shareholder-friendly policies moving in the right direction. I do think the stronger yen will be a headwind. The weekend has been a tailwind for the recent rally in Japanese stocks. It will now become a headwind. And all the Chinese flows that have come out of China and into Japan are now going to go back home as price starts to change opinion. Opinion follows trend. And this move here today, albeit it doesn't mean that it's going to do it tomorrow, but it's the beginning of this regime change that is significantly important for so many of the things that we're doing and for the global change around the world. This will also support small caps. This will also support REITs. This will also support dividend payers, code value stocks like Stanley Black & Decker, Generac, 3M, all these industrials that have been waiting to take off, natural gas companies like Comstock Resources, et cetera, et cetera, et cetera. So very excited here. The 10-year did not know what to do today. It started by collapsing and then it started to get bid up. I think what you're going to see over the next few weeks is while the dollar starts to re-weaken, the yen starts to get bid, the yuan starts to strengthen, the 10-year bonds are going to slowly climb and yields are going to slowly compress. Now, just as I always say with the Fed, because most of the time the move is bad after Powell speaks, and I always say, don't get faked out. The first move is often the wrong move. It may, in fact, be the case that that could be true this time as well. Could we be off to the races for 19 out of 21 weeks up in U.S. equities? It could be. That would be great. I mean, it was very interesting today. I think overall the portfolio was up 2.2% and the general indices were up between 90 basis points and a buck. So, our hedges were moving against us, but the overall portfolio was outperforming the deterioration of the hedges, as we're going to discuss in the article of the week. And it was a great day. 2.2% on any day is great. It was interesting to see, and maybe we'll get even further follow through, and this will continue for another 4 weeks. Who knows? I would be alert. That's all I was going to say. As a matter of fact, I was going to lean into the hedges today, but we already have full 2% of equity capital. That is sufficient to create an extra 10% of free capital if we're right on the 4 to 6% pullback over the next couple of months. But, I wouldn't, number one, I wouldn't be pessimistic because a lot of things are lining up right, and we're going to go through a list of them. And number two, I wouldn't be chasing if I wasn't already fully invested either, especially in the shiny objects that have already run. Because while you might get a few days follow through, I would just keep an open mind. Sometimes that first move is a fake out, and let's see how it plays out in the next few days. I think the real underlying move should be as we look out 4 to 12 weeks, yen starts to strengthen, bonds start to get bid, dollar starts to weaken, emerging markets get bid, U.S. maybe flattish to down, could be flat sideways, which we discussed 3-4 weeks ago. We said probably the move that screws the most people is the indices actually just grind sideways. So they take out all the put premium, they take out all the call premium. And I'd be open-minded to that because that implies the most concentrated stocks slow down and the ones under the surface can continue to get their descent. And we saw, I think today, like Generac was up 4 or 5%. Boeing, which is a big one, by the way, that's our newest where we had space in portfolios. We actually built a position over 3 sessions starting last week into early this week, basis 183. And that's really a simple trade that didn't take a lot of research. All we needed to see was a bunch of bad headlines. And then we said, wait a second, they've got 2 people that make planes. They're the arms dealers. The airlines are the ones that duke it out and beat each other into oblivion. These 2 oligopolists, Airbus and Boeing, and to a lesser extent, this little Chinese thing coming up, they have 10 years of backlog. So at the end of the day, I figured it's a decent risk reward because you've got maybe 60 points of downside if they just keep screwing up, which, I don't know how they can screw up anymore. They can, they've been working overtime to screw up as badly as they can. So maybe they could screw up more, but I think they've maxed out their ability to make mistakes. And if that's true, then to 60 points of downside, I've got probably 240 points of upside over the next 3+ years. I like that asymmetry. Where we had cash, we put it to work. And the blended basis, we got some in the high 170s, we got some in the mid 180s, and some in the low 180s, about 183 across the board. So we like that. There you go. So that's all I have to say about that. Moving forward, this is the key thing that got the market excited, is the Fed saying they were going to stop or taper the taper, meaning they're going to be putting less supply of bonds on the market. When they put a ton of supply that exceeds demand, what does that do? Price goes down, yields go up. When they stop over-putting that supply, because remember, Bank of Japan is no longer going to be a liquidity provider buying those bonds in the open market. Now, they're worried they're going to normalize their policy. So we have to stop putting that supply in the market, or governments won't be able to service their debt. And as a result, the Fed winding down their taper should compress yields in line with the other things we've been talking about. Alibaba, JD, and other stocks rise, lifted by economic data. Expect more gains. So China's industrial output grew 7% year over year, better than expected. Fixed asset investment jumped 4.2%, also better than expected. Retail sales rose 5.5% over the same period, above expectations. So all of that is moving in the right direction as we anticipated. It took a little longer than expected because the stimulus wasn't as robust as we anticipated, but it's coming together. Baba's Hema global shopping business gross merchandise value rises 1x plus year on year in 2023. Significant growth in its global shopping business. And Hema plans to experience 20 add stores to its 66 stores, blah, blah, blah. So that's the one that we talked about as the Costco of China, which gets zero credit in the price of the stock. Here's another thing that gets zero credit. In case you forgot, we own 1/3 of one of the largest financial services business in Asia with trillions of assets, Ant Financial. They made an international arm, an independent unit, and they're going to grow that business aggressively internationally, which we're going to get more value accretion over time. 3 units to set up respective boards. And let's see. Also proposed to buy back as much as 7.6% of its shares in July and grow the business. So that's another thing that we get that is not credited for in the market until it is. Alibaba brings 5-day delivery on AliExpress to USA via Cainiao in battle against Shein and Temu. So I said they're not going to just sit there. And we went through that Financial Times article that questioned some of the numbers of PDD. Pinduoduo reported great earnings today. Stock was up like almost 20%, I think, in the morning. It wound up only 3%. I think people are starting to drill down into their financials and seeing that somehow things don't sync in terms of number of employees, number of square footage, number of invested assets to support the amount of volumes that they say that they're doing. Maybe they're doing it asset light, and that's the better model, and that'll work to sell, low quality goods at a loss. But as the country recovers, they're going to move upscale, and that's where Alibaba owns the world. Similar to how you're seeing in the US, as we recover, the dollar stores are biting the dust, or at least in the short term. And the targets are the ones that are recovering and moving on. So investors don't need to sweat the latest Boeing 737 safety incident. The data show why. They're also buying in that Spirit Airlines, the CFO said today. So they're going to take control back of the fuselage, which was a problem, a lot of their problems. China's fiscal stimulus plan may be bigger than it appeared. Stimulus seen as vital for meeting around 5% growth target. But Beijing's budget math complicated by bond and lending programs. But when you add it all up, what they're saying is it's a lot bigger than everyone thinks. And we're starting to see that reflected in the numbers. From Barron's, PayPal stock has fallen enough. It's time to buy. Ben Levison got our memo, and he lays out the case here. We couldn't agree more. We've gone through the case multiple times, go through the past podcasts. Motley Fool was out with the exact same story. Leader in digital payments. It's time to buy, competitive advantages, cheap valuation, etc. Boeing jet production. Okay, we covered that. Boeing CFO hammers hopes for cash flow. So all the bad news got out today that the stock market was pricing. I think it had fallen from like 270 down to 80 in a few weeks, 180. And that's when we were like, it's time to buy. Let's rock and roll. Where do we have cash? Let's put it to work. And that was great because we had some clients that came in from the last raise that we weren't able to get all their money to work right away. And we were able to get some cash to work quickly. So that's the story there. And then buy 3M stock ahead of healthcare spinoff. Analyst expects higher valuation. Well, we've been saying this for some time. Now it's starting to move. Why? Because you're going to be able to get multiple re-rating on both fronts. They've started to quantify the earplug and the PFAS last year, and now they're going to do SpinCo for the healthcare and get higher multiples at ParentCo and probably SpinCo. We're going to hold both of them. And the stock is now back up close to $110, which is pretty exciting because you're also still getting a 6% yield. Natural gas prices won't stay low for long. An export boom is coming. Core to our Comstock Resources investment pari passu effectively with Jerry Jones, the owner of the Dallas Cowboys. We love this one. We've been adding where we can add, and we cannot wait for this inflection. What a gift to be able to buy at these levels, in our opinion. Again, all of this is opinion, not advice. Go to hedgefundtips.com, click on terms. We deal exclusively with accredited investors and institutions, sophisticated investors. We do not know your financial situation. Talk to your financial advisor before you do anything. As electric vehicle shoppers hesitate, hybrid sales are surging. And by the way, I want to show you, I didn't pull it up before the call because we had a lot of stuff going on here, but Seth Golden had put out a tweet with the average age of a car, which we've been talking about for a year, is 13.5 years. And, but what this image does is it puts it in perspective in terms of how long in the tooth the replacement cycle is. And when it comes, it's going to come all at once. And the catalyst is going to be rates coming down. And captive finance companies from the OEMs like Ford and GM just basically saying 0 interest rates, take our cars. And then the game is going to be on. And you know as well as I know, just like Generac, when in the markets that have the highest penetration, objectively you would say, oh, they're going to be saturated. But it's just the opposite. In Texas and Michigan, where their grid keeps going down, Generac has double-digit home standby generation penetration, and they have the highest growth rate every single year, because once your neighbor has one and the power goes out and their lights are on and you're sitting like a schmuck sucking your thumb in the dark, you say never again and you go buy one. And then the more that the neighborhood gets them, the more that everyone wants them, and it becomes a cultural thing, which is why their 6.25% nationwide is going to go to 10% plus nationwide, and the business is going to double plus over the next few years, in our opinion. But look at the car things as we look at Cooper Standard. This is going to be mind-boggling, this replacement cycle. And that's why we say, even with 85% of production, we think that Cooper can earn $7 a share, despite the short-term higher interest rates cost. And they'll bring that down over time as rates normalize. But we are very excited about that for sure. So that's Seth Golden posted that. Okay, moving right along to VF Corp. This is another one we've been able to add. So Marissa Pardini steps down from Vans. She came in from North Face. She was not part of the new regime. And Bracken Darrell who absolutely created the most incredible turnaround situation in Logitech, will get the job done at VF Corp. He is cleaning house. He is bringing in the right people. He's making the right moves. By the way, look at the offerings of Vans on the website. I mean, there are probably another 2 or 3 pairs I want to buy. And by the way, if you play pickleball or paddle, you should take a look at the Lowlands, the ones that I bought that I showed you last week, Vans Lowlands. They are like retro 1980s tennis shoes, like I guess the Stan Smiths kind of thing. But, you know, Vans became popular because they have the greatest grip for skateboarders that are doing flips and then trying to land back in the pool or on the ramp after doing like a 180-degree flip. Their feet need to stick to the skateboard. If you're playing pickleball or paddle and you're, even tennis, going back and forth, no shoe has a better grip on the bottom that's going to help you pivot so you don't slip or get hurt than Vans. And that's an area that I think they should take a look at aggressively pursuing on that business and bringing in the right people that can turn it around. And I think they're on track on all those fronts. So it's going to take a little longer, but they'll figure it out. They've been doing it for 120 years. If they have to sell brands, replace brands, etc. But here's what you don't want to do. You don't want to sell out of your VF Corp shares and wake up the next morning when they announce that they sold their PAX business for whatever they're going to sell the PAX business for. I have no idea. But let's just say it's $500 million or $1 billion and they pay down debt and they deleverage. Plus they got the cost cuts. Plus they get a little tailwind in business and they get things in order. And they'll be off to the races. And you wake up, it's $5 or $7, and then you'll probably wind up selling in the hole at 14 and buying up at 21. And then what'll it do over the next week? Pull back to 17 before it goes to 30. And that's just the way the market works. But very grateful for the opportunity here to top up. Apple looks to external partners to boost AI efforts. If you're on my new Instagram account, which is handle is Official Hedge Fund Tips, at Official Hedge Fund Tips. This is a brand new account. The old one is Hedge Fund Tips, which we still post automatically. But at Official Hedge Fund Tips, I do like videos every day. So if you want to get updates on what I'm thinking before the weekly podcast, I would not be interested. I could not take more than 1 hour a week of Tom Hayes. But if you are interested, go on that. Or if you're on TikTok, if you want the Chinese government to have all of your data, I always say to people, like, what are they going to do with my data? Call my mom? Like, go for it. Have at it. Like, I've got no interesting data. I live a pretty normal life. So, if you want to call my mom, Xijin, have at it. You can have my data. I'm still on TikTok. So, and by the way, I don't think that's going to get through the Senate either. Too many interests involved in the U.S. that have ownership that aren't going to let that happen. So, so either at TikTok or at TikTok is at Official Hedge Fund Tips as well. The new Instagram, which I'm building from the ground up, which I got like 5 followers. I think actually, let me see. No, I have 139 followers. So be part of the first few before we grow this thing to 1,000 or more and start to grow organically and, build a fresh one that we're pretty excited about. So in this video, what I said was Apple is going to use Google Gemini for their AI. This is so important, certainly for Apple, because Siri is abysmal. I've never seen a worse, like if a student answered your questions in class the way Siri answers your questions in real life, you would move that child to the slowest class possible because that child is just behind and needs extra assistance. Nothing wrong with that, but when you're the largest company in the world, you should have an assistant that is at least middle of the bell curve, and that has not been the case. This was on the weak tail, and now they are going to basically be integrating, or they're talking about it. It wouldn't be public, it wouldn't be leaked if it wasn't happening. Google Gemini, which is great for Apple because now it reinforces the moat around their devices. Because I had spent many days and nights thinking about moving to a Google Pixel device just because it was a phone that I could ask a simple question and get a simple answer very quickly. Siri, I ask a simple question and it takes 10 minutes and I get a stupid series of links that's completely useless. So now that Apple phone becomes valuable, maintains its value, and people use the default, and Google has been paying Apple billions of dollars every year, I think about 10 or 11, to be the default search engine. They will now be the default search and AI engine. So for those of you who think that ChatGPT is the cat's meow, that's no longer going to be the case because people's, or Bing, whatever, Bing had AI search. I mean, they could pay you $100 per search at Bing and people still wouldn't use Bing. It's just mind-boggling. You can thank Bomber for that one. But leaving that aside, when you do searches, Siri will be powered by, or their AI will be powered by Google, which is the best in the world, hands down. You ask it a question, you get an amazing answer. It's intuitive. It's like the smart kid in the room in the AP class, right side of the bell curve. And that's going to be enormous for Google because the billions of people who use Apple iPhones, all they're going to know about effective AI is Google Gemini through their Apple phone, and that's what they're going to become accustomed to using. It's great for Apple because Google's the best. It's even better for Google, and so grateful we own Google from October 2022 and March of 2023, and that's going to be a holder for a long time after this partnership, which is exciting because they got off on a stumblefoot and they've now recovered, and this is the key catalyst, in my opinion, that people aren't paying enough attention to yet. Energy suppliers are racing to keep up with the data-driven energy surge, also the AI surge. Natural gas is going to boom. In addition to exports, it's going to be domestic demand, and that's why we love Comstock. We also obviously still own our Range Resources, a piece from 410, and that's been a multi-bagger over the years. But Comstock is the new one that everyone can get in on the ground floor, in our opinion. That's what we're doing. It's not what you should do. Remember, the filters that I always start with are twofold. Number one, if this position goes to zero as it relates to quality, quantity, and size in the context of the portfolio, will they pull me out on a stretcher? And that's that's my filter number one. So that helps me size a risk in the portfolio. And then question number two is, if I raise the capital to take the entire company private at current market prices and presented it to the board, would they call security to have me removed from the premises, thinking that I was mentally crazy, or would they entertain the offer? If they would entertain the offer because it was a reasonable offer, that is not enough margin of safety for me. I need the bid to be a ridiculous offer, and that's why I love public markets versus private markets, because from time to time, the price at which I can buy high quality business that are temporarily impaired is extreme because the emotions of the public markets enables me to benefit from inefficiencies, and those are the type of companies we focus on. So that's that. By the way, this not only helps the natural gas plays, this helps Generac because the grids are going to keep going down. So stuck in the middle with you, stock market is our article of the week. In 1972, Steelers Wheel released a song, Stuck in the Middle with You. It is a song written by Scottish musicians Jerry Rafferty and Joe Egan and performed by their band Steelers Wheel. The band performed the song on the BBC's Top of the Pops, May 1973, and the song charted number 8 in the UK singles chart. It also became an international hit, reaching number 6 in the US Billboard Hot 100. It was also featured in Reservoir Dogs, great movie from 1992. The salient lyrics regarding this week's market commentary are as follows. Well, I don't know why I came here tonight. I've got a feeling that something ain't right. I'm so scared in case I fall off my chair. And I'm wondering how I'll get down the stairs. Clowns to the left of me, jokers to the right. Here I am stuck in the middle with you. Yes, I'm stuck in the middle with you, and I'm wondering what it is I should do. It's so hard to keep this smile on my face, etc., etc. In the last weeks, we have put on tactical hedges shorts across our portfolio. 1% of total capital in an S&P index put spread. If we get a 4 to 8% pullback in the next couple of months, it has an expected value of 5.61x or 461% gain. So far, it is unprofitable. Another 1% of total equity is a put spread on the semiconductor index. If we get a 4 to 8% pullback on that sector, it has an expected value of 5.74x or 474% gain. So far, it is almost a double. That was as of this morning. It's probably a little less now, but everything else in the portfolio went up. The remainder of our assets are long, i.e. 98% long. So how can you be bullish long and bearish protective tactical short at the same time? The answer is the odds favor a short-term pullback, but none of our active positions are at or above fairly or fully valued. So we ignore the short-term noise and do not create unnecessary tax events in the name of short-term volatility. The several that were fully valued, we harvested profits and reallocated to new opportunities and companies that are just beginning their recovery and have double plus multi-bagger expected values over the next 12 to 48 month time frame. One of those was Boeing, where we had money and we got it at a blended rate of 183. The purpose of the 2% of leveraged hedges and shorts are to, number one, dampen volatility for clients if we do get a market pullback, but more importantly, number two, create 10% of new free capital to go along with at the trough of the pullback. That 2% of quantified risk could lead to as much as 20% of excess returns by year end if it plays out. On the flip side, if the hedges shorts fail, that means the remaining 98% of the portfolio is appreciating, likely at a pace greater than the general indices due to the higher beta, modest derivative overlay, and plain old good stock analysis. In other words, the 2%, quote, lost will be earned back through excess return if the market continues to climb. Today was a perfect example. Our hedges did not work today. The market was up between 90 basis points and 125 basis points, and we were up 220 basis points despite our hedges not working as the rest of the portfolio outperformed the general index. Tomorrow, it could be that our hedges start to work again and the rest of the portfolio takes a breather. We shall see. So while the indices look a little vulnerable here, there are many high quality companies and turnaround stories, turnaround Tom, that are just beginning their turnaround. Here's a sampling of names we've covered in past podcasts that have started their ascent from the lows and have plenty of upside in our analysis. So look at Advanced Auto Parts, which we've covered aggressively in the last couple of weeks. Since we went on with Charles Payne in the 50s, it's now $84 or $85 in just a handful of weeks. That's a big, big move. More than a handful of weeks, about a dozen weeks. But if you zoom out, which we always emphasize, the recovery is just getting started. Shane O'Kelly is whipping that place into gear quickly. Go do a channel check. Go to Advanced Auto Parts, at 5 o'clock or on the weekends, and you will see a bunch of cars parked outside with a bunch of muscular guys putting in new batteries and windshield wipers and all that stuff. So it works. XBI, again, this was one. We bought in the hole. We thought we were a genius. It went straight up, ground sideways for a year, went back and retested. We felt dumb as rocks, and now it's breaking out to new highs yet again. Just getting started, though, okay? Just getting started. It takes a couple years of consolidation. Then when it goes all at once. Consolidation goes all at once. Consolidation goes all at once. Same thing will be true with Alibaba. These have a high correlation, these two, to the US dollar and to Fed policy. It just took the Fed a little longer than we expected, but that's no problem, which is why you do what? No or low leverage, so you can wait through this to get to that. That's the name of the game. Disney's another one that's taking off, from high 70s, low 80s to now $115 in a handful of weeks. But if you zoom out, you can see the recovery is just beginning. Same with Cooper Standard, just beginning. Today it was up over 15, base is 5 and change, a triple, but we're not in it for a triple. We're in it for $7 of earnings, and then you apply 10 or 20 times multiple, peak or trough multiple, and that's where you get the real juice from this. It's going to take a little time, but it's happening. All the pieces are in place. 3M, also lower rates will help that. 3M, people couldn't hate this one enough. They quantified the PFAS. They quantified the earplugs. Now they did the spin. They're off to the races. New CEO. Eventually, good business, good things. Listen, good things happen to people who buy high quality businesses at low prices. If you learn nothing else from me, that's all you need to know. 3M is no different. This is an institution. Too many other businesses rely on their R&D and output. This gets figured out. This starts to recover, and you're off to the races. And this falls into that dividend bucket, along with Disney will eventually get the dividend cooking again, and others. Stanley Black & Decker, same exact story. Big move off the lows of 70. Now it's a $90 stock. This is just beginning, down from 205. It's working its way through. They're taking all the right actions. Inventory's down, free cash flow up, off to the races. They got plenty of cash flow for the runway to turn it. And then as construction and building kick in, and the Inflation Reduction Act, they're the arms dealer. Anything that's going to be built, they benefit. Citi, the sleepy dog, barely looks like it's done anything. It's up from $37 to almost $60 in a handful of weeks, and people still aren't paying attention. By the way, the third filter, besides the stretcher, besides the board kicking me out for a low ball offer, is stop with the moth to a flame stocks. You people, telling you that there's something about the stock market that people have to be involved in certain stocks. You don't have to be involved. As a matter of fact, try a different filter. Next time you want to short a stock or go long a stock, ask yourself, is anyone talking about this? And if the answer is yes, and everyone's focused on it, and you're like, oh, they're all wrong, I'm going to short it, or oh, I missed it, I'm going to chase up the shiny new object, I would just have the discipline to stay away. Do some creative thinking and analysis on your own, and find something that's undiscovered, either overvalued or undervalued, and focus there. Don't be drawn in like 2 years ago. Everyone had to be long Tesla or short Tesla. We've been agnostic on that one since day one. That goes in our too hard pile. There's no way to value it. It's kind of like Bitcoin. So doesn't mean it doesn't work. It just means it goes in our too hard pile. It doesn't fit in our framework. So Bank of America, same thing. You can barely even see the move, except for the fact that it's up from like $25 to $36 in a very short period of time. Baxter is coming out. Remember here, you couldn't give it away because as everyone in the world takes GLP-1s, no one is ever going to need a surgery yet again. People say, oh, maybe that was an overreaction. And sure enough, the stock's up from 30 to 41 and on its way back to recovery. So while many of these have been big moves in terms of short-term percentage gains, they are barely even getting started and not at the stages we would want to be a seller, just to avoid a little short-term bumpiness. More importantly, are some of these names that we've discussed publicly and have barely moved or are just beginning their move along the lines of PayPal and Alibaba, as well as many more we have not discussed publicly and are working on for our clients. So yes, there are some pockets of the market that appear stretched and could use a breather, but could get even more stretched first. We don't know, which is why we buy high quality businesses, preferably generating free cash flow, that are temporarily impaired and on the mend back to normalcy. We hold them until they reach our predetermined analysis of fully valued, regardless of headlines, Fed, wars, noise, politics, etc. We take defined risk, asymmetric shorts from time to time when the odds are in our favor for large gains and our risk is minimal. That's what we've always done. That's what we'll always do. We don't chase shiny new objects and never will. Why? Number one, we enjoy the daily treasure hunt for great, proven, durable businesses at reasonable prices. And number two, it flat out works. Mixed messages. On Tuesday, we put out a summary of the monthly Bank of America Global Fund Manager Survey. This month, they surveyed 198 managers with $500 billion of AUM. Sentiment has definitely turned bullish, but not to the extreme, obvious levels where you can raise a lot of cash and put more shorts on. Managers are just coming out from under their desks after missing much of the 1.5-year rally and now chasing the shiny objects to catch up. Let's take a look at a few points. Number one, the risk appetite is at the highest level since November 2021. On the one hand, you say, see, we peaked 3 months later in February 2022. On the other hand, you could say that is normal coming out of large drawdowns like 2022. Like 2012, 2011. You can see 2013, they had levels. Just look. So peaked 3 months later. On the other hand, you could say that is normal coming out of large drawdowns like 2022. Just look at the Feb 2013 right here. So you can see here, their risk appetite is the highest since March 22. It's at the same level of February 2013 after the 2011 crash. Sentiment was at the same level and the music kept playing for another 2 years. So here, you had risk appetite at these elevated levels, and you got a big crash in 2022. Here, but you were coming off of a massive 2-year rally from the 2020 lows. Here, you had a similar risk appetite extreme, but you had been coming out of the 2011 crash. I think conditions are closer to what we saw in 2013 than 2021, which means this should persist for another year and a half, with some modest pullbacks, normal pullbacks, but not major, 10-20% corrections. Pullbacks of 4 to 8% are normal on the way up. Number two, managers are, quote, the most bullish since January 2022, but nowhere near a peak bullish level that you would ordinarily see before a major 10 to 20% correction. So yeah, we are the most bullish since January 2022, but we're nowhere near the levels that we were in January 2022. So I don't know why they phrase it that way, but I guess they like to catch headlines and stay relevant. So investors say recession is unlikely. They're not yet at an extreme. They're just coming out of their fear zone. Number three, cash levels are down to 4.4% from over 6%. However, the concern signal is usually beginning below 4%, and we're not there yet. Managers are still overweight the Magnificent Seven, but view it at the same time as the most crowded trade. So they're basically saying, we know we're screwed at some point, but we're going to ride it until it stops. And the second most crowded trade is short Chinese equities, and these folks are going to get decimated probably in relatively short order at this point. Allocation to U.S. equities collapsed 13 percentage points month on month. 8% net overweight. However, current allocation is 0.6 standard deviations above its long-term average. So they're above their long-term average in terms of allocations at this point, but not at a level that's beyond excessive where you would set up right before a big crash. Japan. One thing I'm keeping an eye on is the sea change in global coordinated central bank policy. We covered this a little bit. For the past 2 years, the Fed and ECB have engaged aggressively in restrictive policy to drain liquidity and put a lid on inflation. They have largely succeeded during that time. The Bank of Japan was a regular provider of liquidity through ZIRP, zero interest rate policy, QA buying government bonds, and open market purchases of equities through ETFs. That has now changed as the Bank of Japan is moving to normalize its policy and begin a rate hiking cycle. By the way, interesting point, China's government is now buying equities through ETFs as Japan's government is stopping. Without Japan's perpetual liquidity backstop, and by the way, what does everyone want to buy? Japan. What does everyone want to sell? China. Without Japan's perpetual liquidity backstop, the Fed and ECB may not have the runway they think they have to hold rates at current elevated levels while keeping record debt-laden governments' borrowing costs at sustainable levels. That was a mouthful. The point is, that is why you saw Powell signal the tapering is imminent. We will look for clues from the Fed press conference today as to whether they acknowledge this risk, which they did, and speak in a dovish flexible tone, which they did, or they pushed a hawkish agenda citing recent bumpiness in inflation. They acknowledged but did not push the hawk story. Oddly, somehow we are positioned for both. And that is why they say, clowns to the left of me, jokers to the right. Here I am stuck in the middle with you. Yes, I'm stuck in the middle with you, and I'm wondering what it is I should do. Bull bear indicator is near extreme, but not at the extreme levels where you want to go out and sell everything. Just remember, there is always something to do. Dividend yield is relatively inexpensive versus history. Very inexpensive versus history, which is why much of our portfolio is concentrated there and starting to benefit. You saw the sea change in the Generacs and the Stanleys and all the things that rallied today. Value versus growth valuations dipped almost 2 standard deviations below the historic average. These are the times when you want to be a buyer, not a seller. This is the opportunity. That's also a skew in our portfolio. And mid caps are finally starting to get a bit along with small caps. That's going to be the second half story as rates start to normalize. Small caps are going to fly. This is why I was talking with Tyler about UK getting a coffee downstairs at the Mayfair, because of this. Current allocation is 0.9 standard deviations below its long-term average. We want more exposure there. We're looking aggressively to find things that make sense to do. They're also below their long-term average in emerging markets that we've already got handled. They are 1.2 standard deviation below on real estate. That's an interest rate play. That's why we have Crown Castle. We already took profits on Vornado. We may redip. We're looking again at that and one other that we may just not get there in time, and we may not have enough available cash to put it to work, as there's been plenty of stuff to do. So commodities underweight, and we got that covered from some of the names we've discussed. CNN Fear and Greed basically flatlined 70%. It's greedy, but it's not at like the break the scale greedy. And then active investment managers are over 100. That's kind of, they're getting a little bit overweight, and that's why they should get punished. And that's usually what the market does, is it hurts the Johnny-come-latelys that have all piled in the last few weeks after being the most bearish people in October of 2023 and October 2022. Now they're all chasing up, and all of a sudden they've quote been bullish for the last year, and that's usually when the market serves them a lesson, a pretty aggressive lesson. So also want to congratulate Vinay, who came in during the last opening for the smaller accounts, and there were some hiccups with getting him approved, and that finally went through. So welcome to the club. And S&P earnings estimates. So George pulled these together. This is the cumulative 2024 earnings power of the top 30 weights of the S&P was revised up by 2.45% in the last 60 days, and for next year, up 3.31. So a lot of good stuff happening under the surface, despite all the skepticism. That is a big deal. Same thing with Russell small caps. This has been key, and they have inflected majorly. Top 30 weights up 1.89% for this year, up 7.1% earnings growth for next year in the last 60 days. Top 30 weights of the Russell 2000 small caps. That's a big deal. Overall earnings are inflecting back up since earnings season. Earnings growth was 3.3 versus 1.1% estimates. Now we've got Q1 earnings season starting in just about 3 or 4 weeks. I think we're going to fall into this information vacuum now coming out of the Fed for the next 3 weeks, where there are no catalysts and the market just drips a bit lower. Maybe not after today's dovishness. Maybe we get a couple days of follow through, but I think it's got to take a breather at this point, and probably pretty imminently. So, all right, some of the economic data, not a lot here. I mean, the name of the game this week was the Fed and the BOJ. I think more importantly, the BOJ. And now the podcast is over. If you want to stick around, we're going to do the Ask Me Anything questions, where listeners send in their deepest curiosities, and we try to answer them to the best of our ability. So thanks for tuning in. If you like the AMA, stick around. We're gonna spend some good time, and maybe you'll learn something that can be helpful to you as well. Jack Zhang, not sure if I covered this one last week or not, but he wanted me to look at U, which is clear, secure. Deliberate uses 12 months of deferred revenue. Shows their cash flow statement. Cheers. I think we did cover this. I'll take a quick look at it, and then we'll move on to the next one, because he sent that in on Thursday, and I'm kind of confused with the time conversion. YOU. All right, so free cash flow is great. Stock price has been down. Revenues are great. Gross margins seem okay. What do they do? Operates a secure identity platform. Oh, this is the aviation subscription. I use this stuff. And I guess they do TSA PreCheck. That's an interesting... that is an interesting... monopoly that the government could squash at any moment in time. But until they do, it's like minting money like the duty-free guys did in the airport stores, the tax-free selling business. Those guys made billions. This is kind of interesting. So let's figure out, why is the stock performing so poorly? My guess is there's some threat to their moat. That's the only example, because the revenues just keep growing. Cash flow is probably keeps growing. Yep. Why is this such a poor compounder? Let's see, the cash. Do they have any debt? No. Yeah, so this business has only been around 5 minutes, so that's my only hesitation. I think you got a quality business, but Jack, before you do anything with it, what I would try to do is spend all my time figuring out why people are selling it. What are people afraid of? Why do people think it's going away, or is not going to be able to remain this profitable? Are there going to be government intervention? So you got to listen to the last 4 to 8 calls, look at the risks in their going public, the S1, their prospectus. What are their biggest risks? How does, it's a one-trick pony here. It's a very profitable pony. They kind of got as Munger would refer to in the short term, Lollapalooza going. A lot of people getting back to travel. Business travel is coming back full tilt. People want to pay to get through the line faster. What could destroy that? Because if it destroys it, it goes to zero. So if there's some type of guaranteed 10-year contract, looks pretty interesting. Good work. Kyler Johnson, appreciate all the value you give away to me. Definitely a great way to build a long-term personal brand. Would love to hear how you evaluate opportunity cost between investments. There is a lot of opportunity out there, and you obviously have a framework to decide what level of risk to reward each company has. But how do you compare that across companies and industries to pick one over another? That's 20 years of experience, Kyler. There's no quick fix for that. I would say I try to be as uncorrelated as I can. That's not as easy as it sounds, because if you're concentrated in an equity class, but sectorally, I try to be uncorrelated, and then I can weight according to, sometimes the ones that have the lowest expected value have the highest weight because they have the lower risk with the more durable moat. That I could, and the ones that have 5 or 10x upside, they have to start as smaller weights, even though they become larger weights because they have the greatest risk at inception. And that's just something you learn through massive amounts of experience, feel, instinct, and models that you start to run that work best for you. Turnaround Tom from Brady Todaro. What would you foresee any impact on Vornado with buildings it co-owns with Donald Trump after the legal judgment against him? Number one, we don't own Vornado. We sold it at a double. And we would use that up if that does become an issue. We'd use that opportunity to get back in the high teens if we could. I don't think that's going to be a major issue. I think people overestimate how these things play out. Like Elon Musk, Donald Trump is a guy who has 9 lives. He's like a cat, and they just keep coming back, and you can never bet against them. So good luck with that. Number 2, Chipotle's 50-to-1 stock split interest you in taking a position in the future? Absolutely not. I don't chase shiny objects. That thing's already had a monster run. Great business, durable, but whether it stays at a $3,000 stock or a 30 stock, it doesn't change the business, which is, law of large numbers. It probably still has some runway, but, we like to buy things when they're out of favor, not when everyone loves them. And right now, the reason they're doing the split is because all the retail investors love it and they're chasing it. I will say, I eat Chipotle from time to time. The fact that I have to go out of my way to go to one branch over another branch because one branch has the worst employees I've ever seen in the history of humanity, and the quality of the food is not good, and their soda machine never works. I mean, that's amateur hour stuff, and this is a multi-billion-dollar business. That should not be the case in a company-owned high-quality food franchise. Every single franchise should be exactly the same impeccability, and they are not. And that leads me to believe that there's a reckoning coming unless they fix that. Not a reckoning like it has to crash. It's still a great business and a great product. And the branches that I like, I go to regularly because I know I'm going to get the great stuff that I love. And it's great when it's great. But like some of these, you can't even, it's mind-boggling the people that they hire in some of these stores, and the way these people perform is a joke. So you should not have that variability in a franchise model or even a company-owned model, a nationwide brand like that, and that worries me. So at $30 or $3,000 makes no difference. Vincent Sentmore. Hey Tom, hope all is well with you and your family. I've been tracking Malibu boats for a few months and believe it could be a candidate if we do achieve a soft landing. Their fundamentals look very strong. The only concern I have is who the new CEO will be. Higher for longer rates isn't helping, but I do believe that as rates come down, they will definitely be a company that will improve with their stock price going through the 10K. Interest rates and inflation seem to have the largest hurdle for now. I don't like this business. We've covered it a bunch of times on the Ask Me Anything questions. It'll probably work for you. I understand why you like it. It's not a business I'll ever own. Any of these recreation businesses, whether it's Polaris, Malibu Boats, Boston Whaler, I don't know who owns, but maybe Malibu owns Boston, I don't know. But Camping World, all this stuff, it's just too cyclical. It's too unpredictable. Now, I'll look at the numbers with you, and we're probably going to both say, on paper, this thing looks great. And that's the difference between 20 years of experience and, thinking that you can plug it into an AI model and make 100% a year. It's just never going to happen. Experience is the name of the game. You have to have feel, you have to have experience, you have to have knowledge. And all of those three things, for me, this goes in my too hard box or my don't touch box. Not because I don't think the price can't go up. I think it can. But because it's not a durable long-term franchise that I want to be an owner of. It's not a high enough quality business. So look, on paper, straight up, everything's going great except for the last 12 months. Revenues have started to decline. Balance sheet, probably, that's where they might have a little bit of an issue. $55 million in cash. How much debt? Nada. 35 million. Nothing. All right. Cash flow. Cash flow cut in half the last year. Not ideal, but not the end of the world. So did the stock price. With this one, historically, they've been a good compounder. I think you just got to get comfortable with how are they showing any signs of turnaround? I definitely understand why you like this. I think the last time I looked at it, it was in the 60s. Now it's in the 40s. And I probably did say, if it got down into the mid 40s, I'd take a good look. I think this one is worth doing more research on. I don't love the business, but this one might be interesting for a smaller position, certainly for someone's personal account. But I also think there are probably better things to do. So good work on that one. There's nothing not to like on paper, but just instinctually from experience, those type of recreation things, whether it's Harley Davidson or any of that stuff, SeaWorld. I mean, it's just all, it doesn't work over time. Jack Zhang, thanks for the link. Added more. Was wondering what your thoughts are on Canadian real estate market. It looks to me after 30 years, it's finally reached its debt cycle peak. Debt servicing cost, mortgage payment has gone to over 60% of median household income on a national level. Historically, it does not stay above this level for more than 6 to 18 months. So it's interesting that all these stories right now keep the market in place, are almost a mirror image of 89-90. Immigration tight supply. In 1990, they raised immigration cap to 250 a year, but it didn't stop the market from free falling for another 5 years. Though we did not have subprime mortgages, we do have pre-constructions where people can basically buy options on pre-builds. Everyone is happy when the price rises, but when it plateaus or when rates rise, these people have to sell. Also, majority of Canadian mortgages are 3 to 5 year terms and require renewal. Those who bought during the 2021 to 2022 binge will start renewal later this year all the way to 2027. With rates gone up so much, the mortgage payments will double. Was wondering your thoughts on this. Number one, Bank of Canada is probably going to cut, but it's not going to go down to the levels that maybe they financed it in 21. The key is, okay, so you sent me this note, and maybe you're right, and maybe it's going to be a housing apocalypse in Canada. I would say number one, they do have a lot of immigration to soak up that demand. Number two, rates are going to come down. But number three, even if you're right, how do you play that? Do you go short all of Canada? What happens if we get an energy boom and Alberta goes bananas? And what happens if Vancouver takes off with some technological innovation in AI? I mean, there's always something to do. So the question is, how do you play? Do you short the big banks in Canada, BMO and all that stuff? Royal Bank? I wouldn't. I think you have to be cognizant of that. The key is, and I had spent a lot of time looking at how to play shorting Canada housing in the early 2000s when you were also looking at the US. And I would just say it's good knowledge. So what's your play? You're going to short Canadian home builders? I would be more interested, if you want to send in an AMA that's more useful, send in, this is how I'm thinking about playing it if I'm right, and is this how you would express it? That's something I could be helpful with. It's like bad news is coming in one sector of a large economy. You'd be surprised how creative banks get. Brian Moynihan was on Bloomberg today saying, commercial real estate is going to be a slow burn. Why can he say it's going to be a slow burn when you go to Zero Hedge and you read $5 trillion coming due in the next 5 minutes and all this stuff, and we're going to hell in a handbasket? The reason it's going to be a slow burn is because when you owe the bank $5 million, you stay up all night. When you owe the bank $5 billion, the bank stays up all night. And in the case of commercial real estate in the US and housing in Canada, the banks are not going to say, oh, yeah, let's just foreclose on 10 million properties because we want to be in the real estate business. They're going to extend and pretend. They're going to modify mortgages. They're going to extend them. They're going to lower the rates. They're going to do what they have to do to keep them on their books at somewhere near par so they don't have to take all the write-downs and blow out their equity. So, yeah, you might be right about the thesis and wrong about how to make money from it. Because the only thing that matters about this color slide deck from National Bank of Canada is whether you can make money from it. And I think it's going to be trickier in Canada than you expect. But feel free to send in an expression of how you would act on this information versus theory. And then I'll tell you if you're potentially on the right track, or if I would consider a similar expression or not. I could think of a few, but I wouldn't implement them. I'll just leave it at that, despite all of this, what seems to be conclusive evidence. Rashid Zain, thanks for sharing your knowledge. Have you looked at WNS Holdings? Would appreciate your thoughts. Okay, Rashid, let's take a look. WNS. So by the way, here's what happened with semis today. Now you could say, see, it bounced off the trend line again, and that could in fact be true. But until it makes a new high, it's not clear what's going to take place over the next 4 to 8 weeks. Looks like it'll probably have a day or so of follow through, but then we'll see if it actually does, or if we get some final weakness and take out some of the shiny object chasers. Okay, so what's this called? WNS. All right, so it's down about 40%. And what do they do here? Write down Malibu to take a look at that one. All right, WNS. They are a business process management company. Blah, blah, blah. I hate when businesses are in like 80 different businesses. It's like always a red flag. Just tell me what you do in one sentence, please. All right, let's see how their financials look. Financials look great. Free cash flow is steady-ish. Balance sheet. Pretty healthy. Let's see if management's been a pig with share count. Nope, they've been buying back shares. Everything looks pretty solid here. I would definitely explore this one more and look into the last 5 or 10 calls. You may, in fact, have something here and worth a little more research, but not like, oh, wow, jump up and down. You just really have to understand all their businesses and whether they have a moat or they've just been on a run. It just seems like they're serving a lot of masters in all these businesses that they're in. So, yeah, I see what this is. Okay, yeah, this is similar to another one I'm looking at. Okay, all right. Martin Florini. Tom, what are your thoughts on Perigo? As a business, they're a global leader in CPG private labeling and a key supplier to Walmart and major retailers. They've experienced nearly 10 years of declines and are now 80% off their all-time highs. Is this a potential turnaround opportunity with new management and active investor aggressive restructuring plan based on cost cutting and brand building, like what they're doing with Opil versus private label? Yeah, I know about Perigo. I keep looking at it. I keep saying no. Keep looking at it. Keep saying no. Keep looking at it. Keep saying no. Someday I'm going to say yes. Maybe it'll be sooner than I expect. Let's see what they've been up to lately. Over-the-counter wellness solutions, consumer self-care, upper respiratory products, cough suppressants. Yeah, the problem with this, if you recall, like a few months ago, some major government entity came out and said basically none of that stuff that you buy at CVS works, and therefore they should all stop selling it. So you have to understand what percentage of their business was in that category that's eventually going to get thrown out. But they've got a lot of stuff here. Anti-heartburn, so like I guess Pepto-Bismol, that stuff I guess all works. Tums, sleep aids, toothpaste, toothbrushes. All right, so lice treatment. So it's basically all of CVS and Walgreens, which businesses are doing terribly, by the way. So they have to have a distribution through Amazon and others. Let's just see how the financials are doing before we go in with an opinion ungrounded in facts. And the answer is, yeah, it's been dead money. It's basically it's doing 5.2 billion in 2016. Now it's doing 4.6 billion. It's not a grower. It is coming off a little bit off of its 2019 trough, but they still can't figure out a way to make money. Negative earnings. Well, hold on. What about the share count? Well, share count's respectable. They've not been pigs. Balance sheet. $3.6 billion in debt. They started to pay that down. 700 million of cash. 750. All right, it's not horrible. Low quality business, single digit compounder. So, I mean, over time, you can't expect to get a better return in the stock than their ability to compound the capital in the business. And they've been doing a horrible job of that for a very long time. So I wouldn't expect that to change dramatically, although you say the last time they did a decent job was in 2018. So now you say, okay, new management. So I have to get understanding of who is the new management, which could be a catalyst. I mean, it's definitely cheap enough. Does that manager have a history of turning around other things with success? So that's the thing I'm going to look into personally. And then let's see if they've got enough cash to finance the turnaround plan, which is the name of the game. And the answer is yes. Free cash flow, 300 million. That's not too bad. Their interest paid is it's growing. So that's a headwind. I think this warrants further work. I got to understand the name of the game here is going to be who's the new jockey and where did they come from? Let's see. New CEO, Perrigo. Patrick Lockwood Taylor, June 2023. So he's found the coffee machine. Oh, he joined Perrigo from Bayer. Okay, well, this guy, I mean, Bayer is a complete shit show, and that puts it mildly. So this guy was there to blow up Bayer. I would not bet on this guy. Anyone involved in Bayer to blow up a global franchise that had dominated for so many years. So here, he blows up this company from $30 down to $6, and now we think he's going to, take us to the promised land with Perrigo. He can take that journey without me. Hard pass. I mean, how the board could hire this guy after blowing up Bayer. Well, actually, Bayer blew up after last year, and now they're like, oh my God, this guy blew up Bayer, and now we got him working for Perrigo. For me, that would be a pass. I hope I'm completely wrong and the business is too strong to destroy and it'll just start to inflect from good tailwinds, and that's very possible, but not betting on anyone who ran Bayer into the ground because you had to work extra overtime to destroy Bayer. Lana Alexinko, what's your view on the uranium sector? Sector corrected recently with government support. Looks like good opportunities. What do you think of Centaurus Energy, LEU? I would never play a commodity company other than natural gas or oil at very specific times and very high quality up the food chain or some edge that I have. I'll take a look at this thing, but it's already up 60x off its lows. So I don't know what else you're looking for there. Like you're a little late to that party. I mean, it could double maybe, but I like to be in that, when no one's paying it. Filter number 3, no one's talking about it. Now everyone's talking about it because Gates is putting some SMRs up in Wyoming. All right, let's just see how cyclical this business is. All right, revenues. They were doing 400 million in revenues in 2015. Now they're doing 320 million. So that's not a compounder. That's like a gambling stock. Try to buy it when it's down and sell it when it's up. Let's see how their cash flow looks. And my guess is their balance sheet is going to be a mess. Free cash flow is de minimis. Balance sheet is not bad. Not bad, actually. Yeah, I don't know. If you want to gamble on uranium, I'd be more inclined to buy. It's so far off. I avoid the next big thing trends. It's like, oh, hydrogen's going to be big. So everyone jumped on plug power and got their asses handed to them. Solar is going to be the next thing. Now you can't give away solar stocks. EVs, now good luck with your Fisker stock and your Nikola stock and your Rivian stock and all these things that were going to be unbelievable. I mean, it's just, don't chase fads, okay? I would buy a multifaceted conglomerate that if nuclear becomes real again, they will be the beneficiary. It's probably hidden somewhere in GE. It's probably hidden in Westinghouse, in some of the defense contractors, and of course Rolls-Royce, if that gets a pullback, maybe worth getting back in for the long term. But not really for me, Lana. I understand your thinking. I think it's pretty smart, but just go for businesses that compound free cash flow, not these cyclical things that you're betting on government policy and everything else, because that's how you get screwed with whether it's, everyone bought energy stocks when Trump got elected. Energy stocks crashed because all the pumping. And then Biden got in, energy stocks rallied because the supply was going to be controlled. And, clean energy stocks rallied under Trump. They crashed under Biden. It's always the opposite of everything you think. So don't play those games that are dependent upon government policy. Vinod Nemagwauda, thank you for your podcast. I'm sharing with most of my friends. Wanted your opinion on Petrobras. Seems to be attractive and cheap price, low price to sales earnings, has a high dividend, fits emerging market theme too. I can't take country and company and government risk at the same time. And I think with Petrobras, I don't want to wake up one day with a socialist government and all of a sudden I don't own the business anymore. And I'm not saying that's a high probability outcome with Petrobras, but I'm also saying I don't buy up, I buy in the hole. I mean, I would have looked at something like this in 2020, but I was buying Exxon in the hole because that was down to $33 or something like that. And that was when energy went negative, I figured if Exxon's going out of business, then we're all screwed. And we'll go back to the ice age. So I bought that. I wasn't buying Petrobras. I guess I could have bought some Petrobras, but I didn't need to take sector and country and company risk. I just took sector risk and it proved to be an incredible trade. This thing's already up 15x. Why are you chasing it up now to chase a dividend that probably in the first cyclical softness gets cut, or the government says, oh, that's a juicy dividend. We need to finance our social programs because we're socialists, and you're no longer getting it, and the stock drops 50%. I don't want to play that game. I think I'll be wrong, but why would I even gamble that I'm right? So leave that aside. I understand your objective analysis, but these are the things that come from years of experience. Daniel D., you mentioned in a recent video cast that you shorted semis and SPY. I went long put spreads. A defined risk of 1% for an expected value of 5% or a little more than 5x. Why did you choose SPY over QQQ or XLF? Because number one, I don't want to be short banks. Number two, being short the QQQs would have had too high of a correlation to the SMH. And 3, I wanted broad coverage relative to multiples and exhaustion and things that I was seeing in the respective sectors with a lower just like I try to avoid sector correlations on the longs, I also try to do that and have a little diversity on the shorts as well. And this gives me exposure to the general market, and it gives me exposure to a subsector that may need a short-term breather. What's your short-term outlook on XLF, considering Jamie Dimon sold half of his shares? Jamie Dimon has been negative for 15 straight years, every single year. Hurricane Jamie, he was the one telling everyone to short in the hole in the bottom in 2022. Does that make him smart or stupid? No, he's one of the most brilliant business operators in the history of mankind, and probably will go down as one of the greatest CEOs that's ever lived. That's a different skill set from managing money. Completely different skill set. If you remember, I've said repeatedly, the way you make money in real business as an entrepreneur is massive action equals massive results. And the way that you make money as an investor is less action equals more returns once you know what you're doing and know how to buy quality and be patient and not get knocked out of great businesses at great prices just because they're short-term noise, or if it takes a little longer for price to catch up to intrinsic value. So it's just a different skill set. People sell for a multitude of reasons. It's becoming apparent he's going to probably be stepping down in the next couple of years. My guess is he'll take a shot at Treasury Secretary or something along those lines. So he's got to diversify for his family, but they only buy for one, which is they expect the price to go up. And so that's irrelevant. Credit card delinquencies are up. That's useless data. I mean, they're coming off all-time historic lows and nowhere near anywhere that should be concerning at the moment. That could change, but it hasn't changed yet. They have had a run, but they're not really at levels that I want to peel off, but they're certainly not at levels that I would be putting new money to work. I'll leave you at that. CREs are defaulting. We covered that with Brian Moynihan. It's going to be a slow burn, extend and pretend. They're not going to take the marks. They're going to just work with the owners. They'll take back some properties. They'll work out others. And then they'll jump on the Fed to lower rates sooner than later to avoid a serious situation, and that's what will happen. Jim Griffin, my father-in-law were big supporters of your show. We would both listen and discuss your commentary and read the articles you sent on your daily emails. You lost a supporter this week, and I lost a great friend. We were both believers in Baba. He told me he thinks we have a winner, but I will have to let him know how it turns out. I'll keep the faith for both of us. We look forward to your podcast. We look forward to your podcast weekly. We wish the best to you and your family. Keep it up. Sincerely, with great gratitude, Jim Griffin. So, Jim, I am sorry for your loss. Looks like you lost your father-in-law. I'm sorry you will not have a friend to share that with each week. I know what you're going through. I've recently gone through it with my father, and it's tough. It will get better. Just try to remember the good times together, and I'm sure he'll be smiling up there when the position doubles and triples, and you can celebrate together as he's watching over you. So appreciate that loyalty and sharing that. I'm very sorry for your loss. I know what you're going through, and you'll get through it. Jason Zen, I've heard you speak on Bitcoin a few times, but never quite got your official stance or position on it. Now that spot Bitcoin ETFs are available through respected institutions like BlackRock and Fidelity, is this something you would consider allocating a small portion size within your portfolio, similar to a short index position, in just to capitalize on an alternative hedge? And if it does not work out, is not impacting, and if it does work out, it could serve as an IRR smoothing mechanism against the downside. Thank you. Greatest equity podcast in my collection. All right, well, thank you for listening. We have no view on Bitcoin or Ethereum. If you put a gun to my head and said you had to own one for the next 10 years, I would own Ethereum. And that's only because I played golf with one of the guys who invented it, and he explained all the apps that are going to be built on top of it, and it actually looks like a business. The other thing is just basically a scarcity trade. And it's outside my circle of competence. So I don't have a view on Bitcoin the same way I don't have a view on venture capital. It's not what I do. I'm good at one thing. I focus on doing it as well as I can and better than many. And you know, I'm really good at it and I love to do it. So that's where I focus. I don't need to be distracted by shiny objects, or 1 year venture capital has a blow the doors off year, the next year they blow up. I don't need that unpredictability in my life. I just buy businesses that are generating free cash, that have durable moats that I can count on, and I can sleep well at night, and I can put money to work and be super excited because all of my partners come through you know, listening to this, and they're like-minded, very successful people. And I wake up every morning, how lucky I am to get to make them money. I get so excited thinking about my clients every morning and our ability to go on a treasure hunt together, investing side by side, and finding the greatest businesses at reasonable prices. So I just don't get sidetracked with that. There are going to be tons of people that make money in Ethereum and all these applications, but some of these applications, which is why I love talking with the gentleman who was one of the inventors of the software and playing golf with him in Puerto Rico, was that a lot of those, like you had all the applications on the internet in the 1990s, the Netscape, the AOL, and you could play those through public companies. The same thing will be, if Ethereum turns out to be what they expect it to be, there will be many public companies that provide the applications, and I can play it through an arena where I have an edge, versus just gambling on the next new shiny object that everyone thinks they have an edge and no one knows. So I just stay away. I do one thing, it does extremely well for me, and I don't get sidetracked. I get pitched private deals every day of the week, and I just politely decline, and I focus on what I do well, and I keep my focus exclusively on what makes clients for my money, what makes clients money and what makes me money. We invest side by side, we buy quality businesses, and we don't worry about the rest. And there are so many different ways to make money, and if you have an edge with Bitcoin, look into that. I think the people that have an edge with Ethereum, and it's fantastic for them. It's not for us, not what we do here. That is a different podcast. And as far as respectable institutions, I mean, I could go through a litany of dog shit that they've put in a jar and sold human beings for the last decades, whether it's Goldman Sachs, BlackRock, Credit Suisse, any of the major banks, because that's what they do. They package up stuff and they sell it, whether it's Bitcoin, whether it's Ethereum, or whether it's Coca-Cola. And they've also sold some of the greatest things in the history of mankind, some of the greatest compounders in all of eternity. You know, Monster Beverage, that was, you know, sold by a sell-side research firm. So their job is to put stuff out to the public and make a fee on it. That's what they do. Some of it's going to be crap in a can, and some of it's going to be businesses that grow and compound. They took Google private. They took Amazon private. It went down 90% before it was a 1,000-bagger. So I would not feel confident in buying something just because a quote-unquote credible institution sold it to you. I would feel confident because I had done my research and I was comfortable with the product. And in my case, I only buy productive, cash-generative assets when they are on sale, and that doesn't meet any of the criteria. And so I'll leave it at that. And I love the crypto community because I hope they all get rich, because they're all going to have to diversify their money, and they'll give some of it to great equity managers like myself, and I'll help them diversify out some of their risk and grow their capital at a reasonable by very reasonable by their standards, great by normal standards rate, and it'll be good for them and it'll be good for us, and I'll wish that they continue to make a lot more and diversify some to a lowly, humble equity manager who's happy to grow a small portion of their fortune. So we'll leave it at that. JT, Tom, could you please share your view on Cliff? This is a cyclical business. I love the guy on TV because he always yells at the the host and very opinionated, awesome, feisty guy, and a winner for sure. But I'm not in love with that type of business. I think it'll do well from here because I think we're in a similar cycle from 2002 to 2007. So it probably has a second leg. He might get a hold of U.S. Steel because of political considerations knocking down Nippon from buying it. So if you forced me to be in that group, I would consider him. But since I'm not forced to be that group, I'll take a pass. There are better things to do with my money. But you can just see that the guy is a driver, but he's at the effect of being in a very cyclical business. I think you're halfway through his cycle, so yeah, you could probably get some more juice out of this. My guess is it's a very leveraged balance sheet, though. $3 billion of debt, $200 million of cash, but he's generating pretty decent free cash flow. And this guy's a driver. I mean, I would bet on the jockey in this case, but it's generally historically a very low quality cyclical business. And you just might be halfway through the cycle and catch another run. But I think there are better things to do. The time to buy it was at $2 when no one wanted it. Now it's in the 20s and 30s. I mean, you can put some money to work on the pullback, but it's not the highest and best use in my opinion. Sam R, just to confirm, you're only doing tactical shorts on an index level. You don't do at a business level. We do it at a business level, but we will never discuss individual shorts publicly at any time, any place. So with that said, I want to thank everyone for tuning in. We will be back next week, same time, same place. In the meantime, make it a great one. Bye for now.